How can you get the biggest tax break with your charitable giving? Welcome to Retire Today. I'm your host, Jeremy Keil, and we're here to help you create your dream retirement. Today, we're talking about the smartest ways to give to charity in 2025. We're going through the 3 top ways you can save in your taxes when you do give to charity. And this is especially important because there are new rules, some things changing when it comes to 2026, a little bit of change for 2025 as well. So we're going to talk about the rules, talk about these charitable giving tactics. And while I'd say most people are giving to charity because it's something they want to do, it's meaningful to them, they're not giving because of the tax break. But what I found is that you may as well get the tax break. You may as well be intentional with how you give. And often, when I'm advising clients, we're going through and say, okay, do your charitable giving this way. It looks like it'll save you a few $1,000s of taxes. That's an encouragement to give more to charity. It's almost like you're splitting the cost with the government, which is theoretically why these tax rules about giving to charity are there to begin with. They are incentives, encouragements to give to charity. And so if you are giving to charity, let's try to get the most out of it. Now, here's what happens at the end of a year. We're just right at the end of the year, 2 weeks left in 2025. What's nice about that is you pretty well know what your tax bracket is. At least you should know what your tax bracket is. I encourage you to plan out, project your 2025 taxes before 2025 is over. That's what we do with our clients. That's step 3 in my book, Retire Today, is to figure out how to keep more of your hard-earned money and planning out, seeing what this year might look like. Even then projecting out next year. Oftentimes you have a good projection of what next year ought to look like. Now you can make decisions over when you give your money, how you give your money, so that you can get the most out of that charitable giving, most out of your tax window. And of course, it's the end of 2025. There's not much time left. And this is when most people are doing their giving. You do have some time left. So let's talk through the smartest ways to give in 2025. Although to learn that, we got to talk about the One Big Beautiful Bill Act, OBBBA, because that's what changed some charitable giving. And there's some changes from back a few years ago. So let's talk through those. There's really 2 big changes when it comes to charitable giving in the tax bill. There's now this is for 2026. This one's for 2026, where there is a floor in your charitable giving. If you itemize in 2026 going forward, where if you make $200,000 per year and you itemize 0.5%, the first 0.5% of your AGI, you don't get the deduction for. If your income is $200,000 and you give away $10,000 per year, well, 0.5% of your income is $1,000. The first 1,000 of the 10,000 you give away, you cannot deduct. So you're at $9,000 in. Starting in 2026 with that example. So that starts next year. Here's something that starts right now. This is a big change in that it's called SALT, the state and local tax deduction. There was a limit of $10,000 towards your itemized deductions. Now that limit has grown to $40,000 unless you make more than $500,000 of income. That starts right now. And you might be thinking, what does that have to do with charitable giving? I think this is the biggest change of all when it comes to charity, because now you can deduct more of your state and local income taxes, which means you're more likely to have your charitable giving show up as an itemized deduction. And you've got more opportunity to bunch your charitable deductions and your property tax deductions together into one year to get the best out of your charitable giving. I talk through a lot of this info on how you can bunch in some YouTube videos. I've got the YouTube videos. One in particular is called Maximize Your Tax Benefits by Bunching Charitable Deductions. I've got that in the show notes. So the SALT change, you might think has nothing to do with charity, and I think it's the biggest change towards your charitable giving. Now, there are a few others here. Third change, you hear a lot about this. I've seen a lot about this in news articles, that the maximum deduction you can get is 35%. Well, the highest tax bracket's 37%. So if you're out there, you're making big bucks, $500,000 plus, $750,000, $1 million plus, and you're in the 37% tax bracket and you give money to charity, that's great. And you get a tax deduction, but your tax deduction is not off the 37% marginal tax rate. It's at 35%. That's a 2% difference. I don't think it's that much of a difference. Not much of a difference, really, much like this 0.5% floor. But it's a difference, and you want to know that. And those two combine, the floor on how much you're giving next year in 2026 and beyond can get deducted, and the limit on the maximum value of the deduction means that for a lot of high-income givers, the tax preparers are suggesting make your gifts in 2025 if you can. Don't just do that because you heard it. Go out and project your 25 and your 26 income situations, your giving situations, your state local tax situations. See what works best. I've got some clients where we've encouraged to do some extra giving in 25, kind of pulling the 26 giving forward. I've got other clients where we said it looks better for you to do this in 26. You've got to plan it on out. Here's another change, the fourth change really, when it comes to the new tax laws. And I think this is kind of a bigger deal than that whole 0.5% floor and the maximum deduction amount, is there is a $1,000 per person above the line charitable deduction when you standard deduct. I threw a bunch of words at you. What does that mean? It means when you're a standard deduction tax filer, which is most of the people, most of the time, you can still count some of your charitable giving up to $1,000 per person. So that's $2,000 if you're married filing joint. This is similar to what they did back in COVID. I think it was a $300 per person deduction you could do back in the world of COVID, where they're encouraging giving to charity. They know that the standard deductions where your charitable dollars aren't getting deducted because you're not itemizing, it's kind of a discouragement. So they're trying to encourage you to give to charity. That's the $1,000 per person above the line charitable deduction. That starts in 2026. That's somewhat where there's an encouragement more to do giving in 2025, get the big tax deduction in 2025, and then perhaps your giving in 2026 and on is more of the, let me write the check to charity at these dollar amounts to get the above the line standard charitable deduction there. Here's something that has nothing to do with charity that a lot of people are asking me about. It's the senior bonus deduction, enhanced bonus deduction. This is in addition to your standard or itemized deductions. This is not growing the standard deduction. It's saying you've got your standard or you've got your itemized. And then on top of that, if you're 65 plus, you get the senior bonus deduction. That doesn't affect your charitable giving, doesn't affect your standard versus itemized type of situation. So that's helpful, but doesn't change your charitable giving. Hi, it's Jeremy Keil here, and I know you're listening to the Retire Today podcast because you would like to create your dream retirement. I created a free video course to show you just how to do that. Head on over to 5stepretirementplan.com to learn how to create your retirement master plan. That's 5stepretirementplan.com. You can use the number or spell it out. You'll get there either way. Head over to 5stepretirementplan.com. Thanks for listening, and now for the rest of the show. All right, here we go. We've talked about why we want to get into the strategies here. Strategy number one, top 3 strategies for giving money away to charity, especially in 2025. Strategy number 1 is bunching your deductions. Now, I've been an advisor for 22 years, and I heard of bunching your deductions almost right away when I became an advisor, and it was almost all related to paying your property taxes, kind of doubling up your property taxes. You get your bill in December, and you decide, okay, I'm going to pay this bill in January, still before it's due. And then next year when I get the bill, I'll pay in December, also before it's due, but that gives me 2 property taxes that are paid, the checks cashed in 1 calendar year. So instead of 1 per year, you go 0, 2, 0, 2. You're bunching your property tax deductions. I also saw some people that were bunching their charitable deductions, and that, they gave a few $100 every month to church. And at the end of the year, they said, well, I'm going to multiply that out. Maybe it's $300 a month to church. I've already given $3,600 this year. But for next year, I won't give it all next year. I'm just going to write another check for $3,600 on top of it to church. And that's the bunching that I've seen kind of at the start 20 years ago. But the way to bunch even more when it comes to charity, be more impactful, is to use something called a donor advice fund. And the donor advice fund, it's really a way to split off, when do I get the tax deduction from when the charity gets the money? So imagine you're the person, you're giving $300 every month to charity, then you give $3,600 at the end of the year, and then the charity gets nothing from you for 12 months. They may be wondering, where'd you go? They might have also got that $3,600 extra check and think, well, we're going to get even more next year. And then they get nothing from you. So it's really nice for you to choose when you get your tax deduction. You want your tax deduction in a particular year, but then keep your giving consistently to the places you're normally consistently giving to. And the donor advice fund is the way to do that. Most people think, I give my money to charity, I get the tax deduction. It's the exact same thing, but you can really split that apart to say, I want my tax deduction now for the particular year for a particular reason, but then I want to have the money go to charity at a later time for a different reason. All right. So in 2025, you may want to give a larger gift than normal because you're trying to get to the itemized deductions. Often the best way to do that is with a donor advice fund. A lot of times I encourage people, you're giving this certain amount to charity. You're giving $10,000 a year to charity. I looked at your itemized deductions. You're not quite hitting the standard deduction area. Let's give 2, 3, maybe 4 years worth of giving to the donor advice fund. That's a $40,000 perhaps tax deduction this year. And then you give out of the donor advice fund. That way you get the itemized deduction in 1 year and you get the standard deduction you would have had all along. That's the first strategy. And it falls into the second strategy, which is donate appreciated stock investments. Now, this is one of the best tax efficient moves available. You've got money in a brokerage type account. You bought a stock, an ETF, a mutual fund. It's grown. It's made money. You want to give away to charity. If you sell that stock and then write the check, you're paying the taxes on the sale. And yes, you might get the tax deduction, but you also pay taxes on the sale. And it's more tax efficient. You can avoid paying the taxes on that stock if you just move the stock on over to the charity. And that includes a donor advice fund. Most often it is to a donor advice fund. A lot of smaller charities don't have the ability to accept stock, but a donor advice fund would have that ability to accept the stock. This is especially helpful in 2025. 23, the market was up. 24, the market was up. 25 so far, the market was up. You might have in your taxable brokerage accounts money that you want to give away, that you can give away one time to the donor advice fund, avoid the capital gains, and then you can give it out later through that donor advice fund. These strategies all kind of fall together. Now, what's interesting there, when you're giving away the stock, giving away a capital asset is what it's called. It has to be a long-term capital gain. You have to own it for more than 12 months. That's why, what does more than 12 months mean? Most often you'll hear people say, it's 12 months in a day. Just make sure it's 12 months in a day when you give it away. Make sure it's a long-term capital gain. Thankfully, if you work with a place, I know Fidelity does this for sure. I hope a place like Vanguard or Schwab does, but I can't speak to that. I know Fidelity does for sure, that if you have your brokerage account at Fidelity, you have your charitable giving fund, your donor advice fund at Fidelity, you log into Fidelity Charitable, and you tell them how much you want to give, and they look at your brokerage account, and not only do they pull in only the things that count, they only pull in the long-term capital gain investments. They kind of sort it out for you, but they look at these things called individual tax lots. You might have bought $1,000 a month into a stock for 12 months straight, and it's gone up, but some of those months are up more than others because you bought it at a lower price, and they'll go in and they'll pull the tax lots, the specific ways, the ones that get the best tax benefit for you. So that's a good combo. Strategy number one being use the donor advice fund to bunch your deductions, get more of a tax deduction in 1 year, and then you're giving, you can get in future years through the donor advice fund. And when you donate appreciated stocks, especially to the donor advice fund, that's strategy 2. That's a great combo. Now we're on to strategy number 3, saving the best for last because it's the biggest help for last year. It's something called Qualified Charitable Distributions. And you might have heard of these, but a lot of people surprisingly have not. I met a couple a few years back where they were brand new, came to my office, brought in their tax return and their investment statements. I'm looking at them. I see, okay, you got the money came out of your investment statements. They told me they give away their RMD, required minimum, every single year to charity. And when I looked at their statements, I see a higher income in the IRA line, and I see standard deductions, no deductions for charity at all. And I asked them, what's going on here? How do you do this giving your money from IRA to charity? And they said, I want to follow the rules and I don't want to mess things up. I don't want to miss out. So in the beginning of the year, I take the required minimum, put in my checking account. And at the end of the year, I do want to give the charity, and that's just my normal time. And so I write out the checks at the end of the year. And I said, hold on a second. What are we talking about here? They were doing this with about $12,000 per year, and they weren't getting any tax deductions for it. Their previous advisor hadn't told them, their previous tax preparer hadn't told them about this. I said, let's just figure out, what if you give the money directly from the IRA to the charity using the Qualified Charitable Distribution rule? What is the tax savings? I calculated out, it was roughly $3,000 was the tax savings by going from IRA directly to charity. It made a big difference. It's the Qualified Charitable Distributions. You might be thinking, how does that work? What do you mean? So what if they have income, but you have a deduction on there? Well, in their case, like most people I see, they weren't itemizing, so there was no deduction to begin with. But even if they were having the ability to do an itemized deduction, when you have extra money from your IRA show up on your tax return, it often makes more of your Social Security taxed. It might even boost up the cost of your Medicare. It often lowers your ability to take medical deductions. You would be much better off to never have that money show up in your tax return by having it go directly to the IRA. And worst case scenario, you're even. But I don't think I've ever seen that. If you got a tax return where you're absolutely even for taking out IRA money, getting the tax deduction, send it my way. I'd love to talk to you about that. But worst case scenario, you're even, but I've never even seen it on there. So the Qualified Charitable Distribution still starts at 70 and a half. That's the old RMD age. The new RMD age right now is 73. So every time I do a video, I talk about Qualified Charitable Distributions on YouTube. I just posted one out there. I'll put a link to that in the show notes about the 2025 Qualified Charitable Distribution rules. There should be one out soon about the 2026 Qualified Distribution rules. But every time I post that video, the first question anyone asks is, who cares about 70 and a half? Why would you bother giving money from your IRA when you're 70 and a half, but you're not yet to RMD age? And the answer is, again, worst case, you're even. But most likely, what I see a lot of times with my clients is they're living off their IRA money. They're living off the income, and part of their income is going to charity. So once they reach 70 and a half, still take the money out to you that you want to live on, but the money that you were previously taking out and giving to charity, just give it straight to charity. That's a tax savings right there. But even if that doesn't apply, if you're 70 and a half with a traditional IRA and you're giving money to charity, you will end up becoming 73, and you will have that required minimum distribution then. So often you don't mind. You don't mind if your IRA is not growing as much or even going down in value, because you're giving the money directly to the charity. Giving money to your charity through Qualified Charitable Distributions when you're 70 and a half or older will help you reduce your future required minimum distributions. That's why you might want to do that. I go into much more details about the Qualified Charitable Distribution, how to do that in the YouTube videos. All right, it's near the end of the year. Don't wait until December 31 to start this process. Don't assume your 1099 will be correct. These Qualified Charitable Distributions, you need to explain that to your tax preparer so they can get that into the tax forms correctly. When you're giving away your shares, make sure when you give away your investments that you've held it for more than 1 year. Remember to do that. And of course, it's very helpful if you have a place like Fidelity Charitable. I'm hoping that Schwab and Vanguard do the same, because when you tell it how much to give away, it will pull through only the things that hit the rules with the 1 year, the long-term capital gains, and they'll pull through the best tax situation for you. And of course, when it comes to these 3 tax giving strategy, keep in mind the number one thing you need to do with your tax planning, which is project out. What does a tax situation look like this year? What does a tax situation look like in the future? Make decisions so that you can avoid taxes in a higher tax year situation and pay taxes on purpose in a lower tax year situation. If you need more information, if you're trying to choose between the donor advice fund, the appreciated stock gifts, the QCDs, head on over to keilfp.com. Schedule a call with one of my advisors. It's keilfp.com. All right, we talked about how to give to charity. Next week, we'll be talking about why you may want to give your money away. Should you be doing that or not? Thank you for listening to the Retire Today podcast. We believe if you know more about your money, you will feel better about your money and you will make better money decisions. Hi, I'm Jeremy Keil. If you'd like to learn how my team can help you get more income, pay less in taxes, and avoid big retirement mistakes, head on over to keilfp.com. That's KEILFP.com.